The CEO of Westpac says he expects house prices will fall 10 to 15% over the next 2 years. The financial giant's economists have predicted the housing market is about to enter a correction phase in the coming months. Peter King has joined other bank bosses in talking down the risk of mortgage defaults due to higher interest rates. 70% of Westpac customers are ahead with their payments, the low unemployment rate cited as a reason. For more analysis, let's bring in now Eleanor, a senior economist at the REA Group. Eleanor, appreciate your time. Just how soon do you expect the property market will react to rising interest rates? Are we actually already seeing an impact?
Yeah, look, I mean, we are already seeing that so far the climb in fixed mortgage rates, the increase in availability in properties for sale certainly has already weighed on price growth to date this year, along with the expectations of rate hikes. We have actually seen that in April, the share of high price searches on realestate.com.au in capital cities has declined somewhat, with, I think, people expecting mortgages to become less affordable in the coming months as borrowing capacity is reduced with the rise in interest rates. And this is all feeding into what we see at the moment is a kind of bigger picture. Price growth is stalling Australia-wide, and certainly that is more prevalent in the major capital cities, Sydney and Melbourne.
What is your analysis in terms of just how big a hike in mortgage interest rates we are likely to see then in the coming months or year, for example?
We certainly think that when it comes to the expected rise in mortgage rates, that the RBA are going to be a little bit less aggressive with their rate tightening cycle than potentially markets are expecting and some other forecasters are expecting. And there's a few reasons there. You know, we've got a little bit of uncertainty still on the radar at the moment, just in terms of how this inflationary picture really plays out over the coming months in terms of supply chain disruptions and whatsoever. But there's also some uncertainty in terms of how households are going to react to rising mortgage rates. So there's a lot of people out there that have really never seen an increase in mortgage rates. And at the moment, we don't have that wages growth coming through the system to offset, number one, the rise in mortgage rates and rise in inflation. We are hoping that wages growth will begin to materialise. Certainly the RBA tells us that their business liaison program is seeing that wage pressures are coming through the pipeline, and certainly that will go some ways to buffer some of the increases in interest rates. But I think given the fact that we do have some of that uncertainty out there still, the RBA will be much more measured and they will be much more moderate in their rate tightening cycle than certainly some others expect.
I mentioned that a lot of Australians are actually in front in terms of getting their repayments in on time or early. How many homeowners then do we know in terms of they'll be in real trouble a bit later this year once those rates do continue to go up? Is there a serious chunk of people who will be in that position?
It's likely actually that most households can withstand what we expect to be a kind of more moderate tightening cycle. We know that the RBA estimates that the typical owner-occupier borrower is around 2 years ahead on their mortgage at the moment. So households have really used this period of exceptionally low interest rates and the reduction in debt servicing costs to pay down their debt ahead of time. We also know that households are sitting on some 240 billion in excess savings that's been accumulated throughout the pandemic. And of course, a lot of people are sitting on substantial home equity, given the significant rise in house prices that we've seen over the last 2 years. So all of those factors in combination should mean that the majority of households are well placed to withstand an increase in mortgage rates, notwithstanding the fact that we also have banks imposing an additional buffer when people put in their application to borrow. So again, most people have been assessed on a rate that is actually higher than they potentially started off on already. But of course, there are going to be some people that will find themselves more vulnerable. Those risks are likely to be centred around potentially those people who overstretched themselves or have bought recently and overstretched themselves. And certainly if their life circumstances were to change, for example, like losing their job or something along those lines. But again, that picture is offset by the fact that we do have an incredibly strong labour market at the moment, and it is expected to remain so. So the context of the economy at the moment is certainly going to buffer the impacts of the increase in interest rates and mortgage rates, given the economy is in a strong position.
So for those people who do fully now own their own home, when they look at that Westpac forecast of prices dropping 10 to 15%, I mean, that can be a bit of a panic signal to some people. I assume some areas will be more susceptible to drops in prices than others. You mentioned Sydney and Melbourne. What is your expectation into the varying sort of drop that we'll see right across the country, and when you look at cities versus regional areas, for example?
Yeah, I mean, you're exactly right. We are seeing that price growth is slowing in some areas much more quickly than others. We are seeing that it's kind of the larger capital cities that are seeing price growth slowing more quickly at the moment. We've really got a scenario where the smaller capitals, to a large extent Adelaide, and to some extent Brisbane, are seeing momentum remaining a lot stronger. One of the factors that's playing in there is just the availability of properties for sale. So we're seeing that total listings in both Brisbane and Adelaide are still around 30% below decade averages, whereas in Sydney and Melbourne, that availability of properties that are out there that buyers can choose from has normalised a lot more quickly this year, and kind of taken, I guess, a lot of that fear of missing out of those markets a lot more quickly. So it is likely that those smaller capitals could remain a little bit stronger for longer. And also, as you quite rightly mentioned, regional areas. So again, we're seeing that regional areas are buoyed by the relative affordability advantages, the pandemic-induced preference shifts that we've seen towards larger homes, and workplace flexibility has meant that many people can move and take advantage of those cheaper price points, given that they don't have to commute into the office as much as they potentially used to. And of course, in regional areas, we do also have, again, this ongoing constrained level in the availability of properties for sale that doesn't quite match up to the demand to buy them. So we are seeing that price growth is remaining a little bit stronger in regional areas at the moment too.
Eleanor, Creagh, appreciate you joining us for your analysis. Thank you so much.
Thank you for having me.